as follows. That imagine yourself in an aircraft. This is straight out of a book by a guy called Yuval Noah Harari. I don't know how many of you have heard of him, but he's a profound guy. And he wrote a book called Sapiens recently. And for those of you who didn't fall asleep while reading it like I did, I mean, you would have noted this paragraph. So he talks about a thought experiment, which says that you're on an aircraft with one other giant Angolan colobus, which is a form of primate, which is very strong and powerful and sort of harms people left and right. And this aircraft crashes. And you land on an island which is deserted, and the rescue team will take at least 18 months to come and get you. So now what do? Right? You have to survive. You can't do it. It's very difficult to do it because the colobus is just versus you. There's no other human being there. Now replicate this experiment, which is what Hariri says. There's an aircraft with 100 people and 100 colobuses. Yeah? Same air crash, same rescue team, 18 months, you're on a deserted island. Now what do you think happens? The human beings survive pretty damn well. Why is that? Any answers? Correct. So the human beings collaborate. And why do they collaborate? Because they build a series of collective beliefs and myths and ideas which help them to come together, to find meaning and purpose. And those myths lead to, and I'm going to use a convoluted word, but I'll explain it in the context of the stock market very clearly, social coherence. You are able to believe in something that leads you to decisive action, which allows you to then move on. So in the stock market, unfortunately, you need to do just the reverse. You don't want to indulge in behavior that makes you absolutely certain that what other people around you are doing is the right thing to do. And you don't want to be socially coherent. In fact, you want to believe in yourself. Once you put in the effort, once you've done the hard work, you in fact want to be what I call a rational contrarian. That's why the stock market very often is different from what our ancestors wired us to do very well, which is survive, reproduce, and what Charles Darwin said. The species that does it best moves ahead in life. So in the stock market, let me tell you some common myths. I love these myths. I mean, one of them is propagated by a friend of mine who's incredibly wealthy, so people don't want to believe that it's a myth. And the myth can be summarized in 3 words. Bhav Bhagwan hai. It's absolute junk. I mean, let me not waste time. It is junk because the EMH, the efficient market hypothesis, is junk. Markets are efficient 85–90% of the time, but they break down. And when they break down is when opportunity presents itself in spades. That's the time you clean up if you have your wits about you. You can make a fortune that will last 7 generations, not 1 generation. If you're smart then, and if you have thought about it and you're prepared and ready to deal with it. So 2008 was one such opportunity. I pray, I don't think I'll be around to see the next 2008 in my life. But you know, the happiest moment for everyone else, for all of you in this audience, would be if we had a repeat of 2008. It's your only serious chance of getting rich. Yeah, I can hear the nervous twitters here. So all of you think I'm a bozo. Believe me, this is the one sane thing I'm saying till now. You need a 2008 to fulfill your aspirations. Another myth, and this is all the talking heads on CNBC who have no skin in the game. They show up, they talk garbage, they go back and do serious damage. So one of the myths, and I really believe this is a collective myth that has caused unbelievable damage. Large caps are less risky than mid caps and small caps. How? You're not buying cap. You're buying a business. It doesn't matter what the bloody cap of the business is. It's what the business is about that matters. Is it that simple? Have all you guys got it? But go and buy large caps tomorrow. Yep, next. Okay, so I've already touched upon this. And one of the ways in which we've evolved is that we are wired to do a set of things very well, which is not what investing requires us to do. So, you know, if we're walking around somewhere and there's a, you know, we hear a sound or we hear a hiss or something. So we know that there's danger lurking around the corner. So we react very rapidly, we figure out what's going on and then take protective action so that we survive. Because the way the human race has evolved emphasizes survivorship. I think Kuntal spoke about this, if I'm not wrong. So we were hardwired to survive and reproduce. And those who didn't survive, as Nassim Taleb says, obviously didn't reproduce. And they aren't around today. One of the central problems of analyses of the stock market is what is called survivorship bias. So you do a great analysis, but you knock out the companies which no longer exist. So it gives you a misleading picture because you've self-selected a cockeyed sample. So, and I love it because I'm in a city where this is particularly relevant. So there were two blue chip companies when I had started investing in. Ramdas spoke about this, how companies are being wiped out. And it's a trend that scares him and so on in the morning. One of these companies was called Hindustan Motors. The other was called Premier Auto. I don't know how many of you know these names. This is too young an audience to remember them. They both used to make cars. You can see the relics of this in the city of Kolkata, one of them. It's called the Ambassador. The other one is called the Fiat, Premier Auto. And both companies, and there were only two of them, and there's a third company called Standard. But imagine, two producers in a country of 1 billion people, they were so blind and so complacent that both have been wiped out. Takes a lot of effort to do that, doesn't it? So much for the wisdom of the great Mawadi businessman. That's another myth. And it's a myth that is being destroyed and eroded by the day. Wisdom doesn't come to a community. Wisdom now has a Gaussian normal distribution. There are Bengali idiots, there are smart Marwadis, and there are smart Punjabis, Tamilians, guys from Andhra, Karnataka. In fact, the guys from Andhra, I think, if you think about it very carefully on a community basis, the guys, Bihar and Andhra are the two great survivors. If you think about it, they're really the survivors. Neelkant Mishra, who I think is just, I mean, I should touch his feet. I think he's so smart and so clear in his thinking. He should stand out. He certainly does for me a role model to what you need to work towards. Bihar. There you have it. If you look at the ranks of the IAS, Bihar. Andhra, Silicon Valley, you look at the evidence. I think 1 out of every 4 companies in Silicon Valley is promoted by a guy from Andhra Pradesh. That says something. But the fact is that the myth, the other thing is that the brain may just account for 2-3% of the body weight, but it consumes 25% of the energy. So Neelkant spoke of a different energy crisis. I'm speaking of the human energy crisis here. But this is an even more important energy crisis in investing than the one he spoke about. You know why? Anyone can tell me why? Because this makes you lazy. So you try to take shortcuts. You're hunting for shortcuts in decision making. Heuristics, for those of you who heard it, Daniel Kahneman, thinking fast, thinking slow, system 1, system 2. So because the human brain consumes so much energy, it likes to operate in system 1 mode, where it takes spontaneous, immediate actions based on limited evidence. Right? Whereas more deliberate, deep-rooted thought process, thinking based on data, on collection of evidence, which then leads you to an outcome, consumes much more energy. It's far more troublesome. So I'll give you an example between my wife and me. So she says, you know, you need to give me some money to run the house. So I say, how much? So she'll say, 25,000 for now. I'll say, that's too much. There's no thinking on my part and there's no thinking on her part. She knows my response, I know her response. It's totally irrational. But believe me, it works incredibly well here. But don't bring this approach to investing. That's my sort of fervent plea to you. Put in some more effort. Okay, next. Yep. So, one other wonderful thing, and I want to ask this audience because there's so many guys here, and I think the point is made easily. So, let's pick Vinay Bagli, since I can see him, and he's a good guy and a rational guy. So, Vinay, how much money would you consider enough in a lifetime that would make you feel happy? Yeah, forget. So, do you think you're happy at 100 crores? You're a liar. I'll give you F for honesty. F for honesty, but a hell of a lot of credit for getting to 100 crores at your age. But the truth is that most of us are never satisfied with how much we have. We are on what is called a hedonic treadmill. The minute we have X, we want X plus epsilon, or we want more, because we feel that having got to where we have, clearly that can't be adequate. And that is what creates, a conflict in your head, in your brain. You have what is economically rational fighting with what is emotionally rational. That trade-off is a very difficult trade-off to make. And I'd like to suggest this, that once people know that there's a reward, so the brain gets activated in ways that are physiological, like dopamine, cortisol, so on and so forth. And the release physiologically of various chemicals in your head, which send signals to different parts of the body, is such that your decision making tends to be skewed in terms of taking more risk. And your decision to take more risk is greater when markets are bullish, and your willingness to take risk is reduced when you think you're in a bear market. And that's why, barring smart guys like Navneet, most people, they do not want to buy in bear markets and sell in bull markets. What they want to do is no buying low and selling high. They want to buy high and sell low. In fact, there's one very wise gentleman in the mutual fund industry. He says, boss, apne ko the risk hi nahi lene ka, hamesha 100% invested rehne ka. Sounds wonderfully elegant, doesn't it? Till you think about the damage it's doing to you. A lack of application, a lack of effort by a human being blessed with a great brain is the greatest sin of all. There can be no greater sin than that. That God has given you a brain and you refuse to use it. That, I think, is front and center the biggest message of behavioral economics. Okay, yep, next. Yeah. So I've spoken about this. This is an important one. I was speaking to a friend's daughter, and she was telling me, and with great logic and clarity, that uncle, I'm stressed. And life is tough because I'm stressed, and people are, making me do things I don't like. It's absolutely right. If people put you under stress, your behavior turns irrational. Your willingness, your desire to be flexible, your desire to take risk, your desire to sort of respond to others in a rational manner plummets. And the consequences of that for everybody, that person and the other people he or she is dealing with, it's reflected in that stress. So one of the important things you've got to do, and Kuntal spoke about this, I think, is you've got to eliminate situations which induce fear and which cause stress if you're going to be a successful investor. And I'll come later to a very Bengali model of how to avoid stress. It's called HALT. So when I am in 4 different states, I just don't do anything. I stop. Okay? So being a Bengali, you can guess what HALT is. The H is hungry. Second one is also very Bengali, angry. Third one, lonely. When you feel isolated, when you feel that others are conniving against you, when the world is wrong, you are, I feel that way very often, incidentally. I mean, so it comes to me naturally. And the last one, this is an important one for the practitioner, tired. Don't make investment decisions, at least for me it works. When I find myself in one of these 4 states, I just walk away. In fact, the less decisions you make as an investor, the better your record is likely to be. It's funny, but we get to that. Okay. Yeah. There's another thing about this. So, when you lose money, especially big money, it does funny things to you. You never forget. And very often, those losses are not attributable to rational thinking. They are contextual. They're driven by what is happening outside of your control. But you never forget that you lost money. So, there's a saying in the stock markets that for a guy who's never seen a bear market, it's much easier for that guy to be bullish than a guy who's seen 3-4 bear markets earlier, which is why I'm a perpetual bear most of the time. Because I've been so scarred by what I've seen. And then I have a friend with whom I'm having dinner tonight. He's just like me, my age. He has a son. Very smart guy. Clear thinking. But he's never seen a bear market. So he's usually optimistic. Now, there's no right or wrong in this. It's a question of remaining rational. And people who have taken hits are loss averse. It causes them great grief, and they are reminded of how stupid they've been in the past. It's like looking at your face in the mirror and saying, God, what a bozo you are. The mirror tells you, you look like a bozo. And you don't like that image. So you don't want the mirror. And the minute you stop using the mirror, you're the loser. You've got to hold your face up to the mirror every day in your life in investing. Try and figure out what you're doing wrong. That's the best way to improve. Sounds paradoxical, right? But it is. Okay. So, physiologically, we aren't wired to get this right. So the best example of this, and you'll get this now. I wasted so much of your time, but I still must tell you this one. So in Israel, they hold parole hearings for prisoners. Yeah? So there are a bunch of judges. There's an application that this guy should be let out or given bail and whatever. That's called a parole hearing. So American professors have to get tenure. They have to do some research, especially in the area of psychology. So one of them rolled up to Israel. Anyhow, he was a Jew, so he wanted a holiday. But they call this research in America. So the guy rolled up and he analyzed the decisions that judges gave starting from the time they appeared in court in a blocks of time. So from breakfast to lunch, then lunch to when the court closed. So what do you think that guy found in his research? Very interesting. So just 1 hour before lunch, the chances of your getting parole declined dramatically. But if you were lucky enough to get your hearing after breakfast but before, let's say 12:30, or your hearing was at about 4:35 before you was about to go home and again hungry, the judge would, the outcome of getting parole was much worse. And this is actually verifiable. It's been done, repeated, tested again and again. Simply because judges feel hungry 1 hour before lunch, they become nasty. You're laughing. This is incredibly important. This is the most important thing I'm going to say in this presentation, and you're laughing. That's my life, story of my life. Okay, let's move on. So, essentially, this is something that, this is why I think India doesn't have that many great investors. You know, when you go to the United States, and you talk to people, and you have a conversation about investing, the conversation very quickly gets to thinking about risk. In India, and this is a typical conversation, where's my next multi-bagger? It's bizarre. It just shows you how ridiculous the typical Indian investor is. Sensible investing is not about finding multi-baggers. It distorts your process, it distorts your thinking, it distorts any sane attempt to weigh evidence. It betrays greed. I mean, I'm really sorry to tell all you guys that you're greedy. But it's a truth. And the sooner you come to terms with that truth, the better for all of you. The guy who has rational expectations in terms of time horizon and obviously has more rational risk tolerance. So all sensible investing is about thinking essentially about how to manage risk. This is true about fixed income, this is true about equities, this is true about any attempt at investing. It's not about equities alone. And second, in the equity market, if you think about it, we have three types of risk. So one, you can't do much about it. In the CFA program, they call it idiosyncratic risk, I think. Is that right? Have I got it right? What is it called? It's idiosyncratic risk. Okay. The second one, sorry? Yeah, I never cleared my CFA exam, so you'll have to excuse me. But my vague memory is that it's called idiosyncratic. In the old days when they first invented it, it was called idiosyncratic risk. But I don't know what they call it now. Specific risk, you know, that. The second one is business risk, kind of business you own. But the third one is the one I want to sort of talk about a lot. It's about you and the environment in which you operate. Behavioral risk, how you behave. That's something you can do a hell of a lot about. And if you can remove that element from the risk that you take while investing, you've already guaranteed far superior returns. So behavioral risk. So what is the crux of behavioral risk? Basically, there are hundreds of things. I mean, I could go on and drone on and on about it. But there are four primary elements. Ego. So when you don't have ego, you're done. I mean, nirvana, close to nirvana. But we'll deal with the definition of ego and how you can at least tone it down. Conservatism, which means you don't want to change basically. You love the status quo, how things are, and you want it to continue that way, and you want to not accept things that tell you that you need to change. Okay? Clear signals that indicate that. Third, attention. So your mind focuses on things that are very recent, very vivid, where it doesn't weight information by base rate. In other words, how frequently those things happen. So in the US, there are far more deaths that happen because of car accidents than plane accidents. But if a plane crashes somewhere, everyone says, oh, I don't want to fly. They cancel their flight tickets and say, I'll go by car. That's how it is. Someone saw a shark attack on an island in Hawaii. They said, I'm never going to a beach again. There are less deaths from shark attacks every year in the US than there are from millions of other things. But that's how the human mind works. And the last one is common, emotion. You can have different kinds of emotion. Greed, fear. Those are the two basic ones. You can have varieties of, emotional, what shall I say, ups and downs. But the greed and fear ones are the really powerful ones you got to come to grips with. Okay, next. Yep, this one. Okay, this is really bad. Yep. So how many of you drive over here? Drive a car? It's about 50, 60 of you. Blessed are you who don't drive. Obviously, you're wealthy enough to have drivers. What a wonderful stage in life to be at. Okay. I like that. How many of you are above average drivers? Good drivers, safe drivers. Yeah, Vidhu, I can believe. What about the rest? This is a room filled with bloody liars. That's my one solitary conclusion. I can say that with absolute and total conviction. Because you know the answers in advance. That's why you're lying. Very bad habit. Don't do it in future. But I'm determined to prove my point. One sec, I'll nail you guys. Just hang on here. I'm going to pick people and nail them. That's the only way to get the message across. Okay, you have a smile on your face. I love people who are happy and smiling. So, no, you can sit there. Just relax. Don't be tense. So, you know a Boeing 747? Yeah? I want you to tell me a range of what you think an empty Boeing 747 weighs in tons, such that you have a 90% chance of being right. A 90, what do you mean? You never seen a Boeing 747 in your life? You have. Why do you say no idea? I'm saying you can give me a range. I'm not asking you for the exact answer. Yeah, help him. You'll help him to go wrong. Help him. Everybody wants to help him, please help him. 0 to 100 million tons. Come here. You can continue this presentation. But that is the right answer, by the way. He mucked it up a little bit by saying 0, which shows that he's a cheat. Because the plane can't weigh 0. But he's read the book. So he's got the right answer. But this is a central failing of the human mind. Most people will say 365 to 800 tons. Why do you need to give such a narrow range? Because you're overconfident. That simple. Overconfidence. If I had to pick one reason for the biggest number of investing errors in history, it's overconfidence. It is rooted in the belief that you know better, know more than others. Once you get over that one solitary problem, you're fine. Then we can't accept that we are wrong. So we always look for evidence to support our point of view. So when I was I reached my level of incompetence very quickly when I joined HDFC. But be that as it may, I had never managed public money in my life, and I started at the level of my incompetence as CIO. So I had a lot to learn. And so these brokers and analysts, they're dangerous people. But I didn't know it when I started. So I used to believe that, once I have some bright idea to invest, if some other smart guy, and I used to treat everyone in the team as my equal, which I realized with hindsight was a huge mistake. What the hell? Why was I called CIO? I should have run roughshod over all of them, but I didn't have the wits to do it then. So I thought I'll persuade them of how smart I am. So I used to very surreptitiously call an analyst who thought like I thought. And I knew he was going to say, boss, this is a great stock. And often he would ask me before he started, sir, what do you think? So I tell him, this is what I think. So he'd say, Infosys is a great stock. It meets all the tests that we look for in investable stocks, investable ideas. And I'd say, gosh, you hear that guy? He said, it's a great stock, yeah. And I've been saying we should buy Infosys, right? So it's just the bloody reverse of what you need to do if you're smart. How many WBBs are here? I thought the room would be filled with WBBs, yeah? He's done the greatest damage to this country in 50 years. You don't know what are WBBs? Warren Buffett bucks. इस कमरे में कम से कम 100 होने चाहिए, हाथ ऊपर करो. साले इतने कम, बहुत ही हरामी लोग बैठे इधर, बदमाश और हरामी सब साले. मैं मोड खोज रहा हूं सर, आप क्या कर रहे हैं? मैं मोड खोज रहा हूं सर. ब्रांड सर, ब्रांड प्राइसिंग पार आता है सर, प्राइसिंग पार आता है ब्रांड. Neither are you Warren Buffett, nor do you have his intellect, nor do you have his temperament, but you want to be Warren Buffett. The next wannabe Warren Buffett. Get rid of that habit. Learn to be comfortable within yourself. Know who you are and be comfortable with that idea. That's part of smart investing. But Warren Buffett has a very intelligent sidekick who gets far less attention than he deserves. It's just the same case between Ramdev and me. No, I'm not more intelligent. But I'm Ramdev's chief sidekick. So, Warren Buffett's chief sidekick, guy called Charlie Munger, he had something very interesting to say. He said, whenever you have an idea, look for things that are going to prove you wrong. Invert. His favorite phrase was invert. Disconfirm. Try and find guys who will tell you you're wrong. So if you're a practicing investment manager, as many of you already are or will become, hunt down the analysts who have the reverse view to yours. You're doing yourself a huge favor by doing that. In fact, it should be institutionalized as a practice in investment teams. That is best practice, incidentally. You must encourage dissent. If you don't encourage dissent and you have homogeneity of opinion, you're setting yourself up for a crash. Whenever there's homogeneity of opinion, you're vulnerable. If everyone believes something, what am I talking about? Kuntal Shah made this point so much more elegantly than me. He said if 9 people believe is true, then what should the 10th guy do? That's it. So I owe him. And I owe all of you an apology for droning on about this. Okay, we move on. No. Back to the previous. Yeah. So there's an even better one. I'm passionate about something. I believe strongly. A guy comes and tells me, boss, you're wrong. आपको समझ ही नहीं है इस चीज के बारे में. So what is my reaction? I become even more strongly rooted in my existing belief. You've never done this, right? None of you have ever done this. None of you have ever done this, right? Has any of you ever fallen guilty of this? 1 guy, 2 guys. Shit, yeah. What a bunch of wonderful people. The bloody whole room is filled with people like this. This is very important. When someone attacks your worldview, the rational thing to do is to think about why he's attacking your worldview and try to collect more evidence, more data to modify that worldview. And if you find that the data supports you, the evidence supports you, then and only then do you stay with it. But you don't become more rigid and stubborn in your view just because someone challenges it. Yeah. So this is about fund managers. This is me in spades. Those with limited knowledge fail to recognize their own lack of skill. And those with specialized knowledge cannot bear to say they don't know. How can a fund manager say, I don't know? Someone asks him, sir, what is going to happen to interest rate cuts in the US? He'll say, ho sakta hai, 2 in the next 12 months, but there is something that if the recession becomes less, the guy is clueless. Jerome Powell doesn't know. What will this bloody dumb bloke know? But they all come on TV and say, we think too. That's because of this. The more random a situation, the more certain we tend to become. This is incredibly dangerous. Next. Yeah, this is what I spoke about. I told you what it is. You want the status quo to persist. You're unhappy with change. And why is that? Because 2 reasons. Because you need to think. If something changes, then your old thought process needs to be modified in the light of that change. So you need to make your brain work. Second, and this is a very important one. You have a wonderful aunt. The aunt leaves you ₹1 crore behind in a will. And then you earned ₹1 crore because you're incredibly smart. You're 30, you're smart, you have ₹1 crore and you have a very wealthy aunt. This is the situation I should have been in many years ago, but I wasn't. So now, there's a huge difference between how you invest the ₹1 crore that you inherited and the ₹1 crore that you have. Right? Why is that? Because taking action leads to the likelihood of greater regret if you get it wrong than if you do nothing. And any other money you receive from your aunt is pocket ka paisa. So might as well stay where you are, right? Isn't it? Isn't that right? Anyone who disagrees with this? No one disagrees, right? So it must be right. It's completely bloody wrong. It's loss aversion. The desire not to have regret that forces us to not take action when it is necessary. Because we don't want to look in the mirror and say, gosh, you're an idiot, you're a bozo, you took this action and you lost money. So it's much more comfortable to do nothing. But doing nothing is doing something. And I don't want to sound like Socrates. But doing nothing is a willful act of omission. कैसा लगता है सर ये शेयर? होल्ड, बहुत अच्छा, होल्ड करो. Yep, that's what happens. Typically me. Okay, we'll get on with it. Not to worry. Yeah, wonderful. Okay, this is how my life goes on. This is how I invested also. Press the wrong button, someone helps you out. Okay. So, there's another thing about this, about conservatism. So, you know, how many decisions do you think you make in a day? Any guesses? This time I'm going to be nice. You can just say what the hell you like. So, thousands is what? 100,000, 500,000, 20,000? You would have got damn high grades when you were in your MBA because you know how to pick up. Thousands. तो बोलिए कितना? है? 1 to 10 क्या मारा आपने तीर लंबा ठोका साला. Okay, anyone else? 40,000. Who's this guy? You're a practicing shrink. You've done a PhD in psychology. Indiani, give him a toffee here. He deserves it. He's very close to the right answer. The right answer is 35,000. Most of us in a day, we make 35,000 decisions. We don't realize it. Which shirt should I wear in the morning? The white one or the blue one? The blue one. Why? I mean, I made a decision. My mind processes it very rapidly. So one of the things that happens is you don't want to spend too much time and effort making these decisions because you stretch yourself to the limit. You want to conserve energy for things that in your list of priorities are very important. So that's why you prefer sameness. You make decisions on the basis of what you've always done. Because it's too tiring, it's too painful to, if I go for this presentation at 3:30 in the afternoon, should I be wearing a jacket? How many other people will be wearing a jacket? That's the first question that comes to your mind, right? Will it be a black jacket or can I have an informal, you know, a Nehru jacket kind of scene? So Navneet will probably be wearing one of those. So it's okay for me. So then it's 4-layer thinking, 5-layer thinking. So what does Sanjoy Bhattacharya do, being the bozo that he is? He said, just bloody wear a shirt and be done with it. The nearest one in the suitcase, pull it out, wear it and get on with it. Is it suboptimal? I don't know. But that's how it works. Okay. There's another thing. Why you don't want to change. There's a thing called a sunk cost fallacy. Something has already been done, right? And you don't want to go against that. So you've got a ticket to go and see the final of the World Cup and you paid 100,000 rupees for it. And then a torrential rainstorm hits Bombay. Now what are you going to do? And second one is some kind broker gives you a ticket for the final at Lord's. You haven't bought the ticket. Your reactions are incredibly different, boss. Oh yaar, barish ho raha hai. Dangerous. I don't want to fly tonight. You look very sad. You say, you tell everyone else, you know, I had a ticket for Lord's. Malum hai? Magar main gaya nahi. Well, when you paid 100,000 bucks for the ticket, you ring up Air India or British Airways or whoever the hell and say, brother, make sure that flight takes off tonight. Otherwise, I'm going to set off a bomb in your office. Why? Because you paid 100,000 bucks. It's a sunk cost. The Vietnam War, America is one of America's many expensive blunders. Why was it that they continued to send troops, that people continued to get killed? There's a sunk cost. Too many US presidents are too much invested in the first decision. Why did I continue to own Infosys from 2000 to 2018? Because I'm a moron. Because I owned it from 94 to 2000. At 100p, here I am, this great investment guru. Ramdev says I'm his guru. I mean, he must be having bad gurus. But at a PE of 100, I couldn't sell Infosys. What the hell was I doing? Was I sleeping at the wheel? Clearly I was. Because I thought Infosys is better than all the other companies. So if I own Infosys, it'll fall less. It's got that great management team. It's such a wonderful business. ROE is so high, X, Y, Z. Guess what happened? From 31st March 2003, the price of Infosys went from 13,000 to 2,600. Okay. So much for my being an investment guru. At least I've said that one right. Okay, next. Yep. Let's go to the next one. Yeah, sorry. And then we have this thing called, one before, sorry. Can we go back? Yeah. There's a thing called the endowment effect. So if we own something, we love it. It's worth more than something that we don't own, though that thing may be identical. Why is that? Because you own it. You're the smart guy. You're smarter than the others. That's why you own it. So it must be worth more, right? So this is another wonderful experiment. So people in Cornell were given mugs that they bought for $4. And they paid $4 and bought it. And then they were told that people would make offers to them to buy it. And then they also could bid in another situation where there's a different mug, which they could buy from other people who owned it. Very similar mug. So when people made offers for the mug they owned at $6.50, they said, no, it's worth much more than $6.50, yaar. How can it be? But when they had to bid for other people's mugs, which other people owned, they said, yaar, so char bhi nahi hai. I have a friend of mine, he's a wonderful guy. One of the greatest legends in Indian investing. He and I talk quite rarely now, mainly to my detriment, but I'll never forget this. A Gujarati guy, wonderful guy. So I rang him up. I said, boss, what's the price of this share? I knew he owned it. He gave me the price down to the last bloody tick. Bhatta is 140, yaar, 139.75, 140. I was very impressed. Then I told him something that I owned. He said, hi yaar, wo kuch 200, 210 hai na? When the price was actually 225, because he didn't own it. I owned it. This happens to all of us every day. This is a manifestation of the same disease. And to the extent that we undervalue what we don't own, we can make serious errors of commission because we don't own it. Right? That's why selling is the most difficult part of investing. Selling is the dark continent of investing because of this. You know, if you had to do one thing smart in your life, it wouldn't be buying, it would be selling. I don't know how much, if you broke up your time in terms of an analysis of how much time you spend on selling, buying, restructuring your portfolio, thinking about risk, macro, X, Y, Z, I'm willing to bet selling would be less than 2%. Finding the next multi-bagger, 85%. Okay, yep. Next. Yeah, so we depend on things that are vivid, but don't necessarily have high probability. So it's based on the idea of how easy it is to recall. So someone says, IPOs, boss, kharidna chahiye. Because just 3 weeks ago, someone bought Tesla or whatever and made a shitload of money. Or your grandfather told you how he bought Colgate in 1978 and how he made a shitload of money. But IPOs are stacked against the average investor. It's the dumbest thing to do, barring institutional investors who have a different set of, they play with a different set of cards than you and I when IPOs get dished out. And even then they are exceptionally dumb to be buying IPOs. If you see in your latest fund that the fund manager keeps on buying IPOs, know that he's underperforming. You know why they buy IPOs? वो थोड़ा सा boost मिलेगा ना सर, first trading day के बाद तो थोड़ा बढ़ेगा, 10-15% ऊपर जाएगा, so he rigs the whole bloody scheme. He goes to the broker and gives him dhamki. सर साले तूने मेरे को अलॉटमेंट नहीं दिया ना, मैं तेरी चटनी कर दूंगा, 3 महीने कोई ब्रोकरेज नहीं, बंद कर दूंगा. So the broker also shit scared. He gives them a good allotment. Then it happens. What is that word called, Navneet? That first day. Pop up, pop up, pop up. Yeah, it's like popcorn. In my head, I confuse it with food always. Yeah. So pop, pop. वो pop मिलेगा. Pop मिलके बेच मारा. He's just trying to rig his NAV. That's the last type of goddamn fund manager you want to have. Guys who have high numbers of IPOs in their portfolio, dangerous characters. Okay, next. Yeah, emotion. This is because when things happen to us that are powerful, we are driven by how much it affects us in terms of how we feel. So if something good happens to us, we continue to do it, regardless of whether it's in our best interest or not. And if something bad happens to us, then we immediately say, no, this is hurting me, I don't want to do it anymore. And that's ridiculous. I mean, if you look at how to deal with risk, emotion is one of the most dangerous things that you're dealing with, because your view of risk is based on your state of mind at that time and how it has affected you. It's not based with reference to probabilities, with reference to the other outcomes that are possible. It's not based with the payoffs that are attached to that outcome, but it is based on how you feel. Yeah? So that's why all of us look at our portfolios every day on the screen, right? We all have Excel sheets or connect with money control, Bloomberg, depending on how wealthy you are. And every day, at the end of the day, you say, outperform kiya. Today I was up 42 basis points, the market only 38. I'm a genius. You're doing yourself incredible harm. Incredible harm, because you're perpetuating what is completely random. You need to stop doing that. In fact, if you look at how your portfolio has performed once in 6 months, you're fine. You shouldn't be looking at it more often than that, because it will ignite emotions in you which have a high chance of making you do something stupid. Okay, next. So how do you deal with ego? So ego is rooted in these 3 things. Either you believe that you have greater control over something than is actually the case, or you think you're smarter than others. You're in America, there's this guy called Garrison Keillor, the novelist. He wrote about a town called Lake Wobegon. Everyone is above average in that town at everything. We belong to Lake Wobegon in investing. And or you think, this is the one I really love. Forecast. I can forecast next year's EPS. It is going to be 8 rupees 55 paisa. And people actually believe those forecasts. They spend time, effort, they make decisions based on that. Forecasting is for morons. This is rule number 1 in smart investing. Never try to forecast. It's for public entertainment, tax-free entertainment. It has zero value. It just tells you something about the character of the forecaster, that he's a cheat, because he pretends to know the future. No one knows the future. All kinds of forecasting is bullshit. What is GDP growth next year, sir? 6.4%. Might as well have a hat out there and pull out a number. What is the record of forecasting in equity markets? I hope you guys know the answer to this one. No? 85% of forecasts made by the highest paid equity analysts were off by more than 15% from the actual result after 1 year. But the beauty about analysts is that they revise their forecasts every 3 months. After the quarterly revision and sucking up to management and trying to find out what the earnings are, the answer was that on a quarterly basis, more than 90% of them were wrong by more than 8% on a 3-month basis. So much for bloody forecasts. Okay, but you want to do it, you do it. 90% of them were wrong by more than 8% on a 3-month basis. So much for bloody forecasts. Okay, but you want to do it, you do it. So now, let's move next. One of the things you can do to protect yourself against your own ego, deeply rooted in us, is to diversify. And this doesn't mean that you lack conviction. Yeah? All it means is you don't have a portfolio with 8 stocks. You don't know when you're going to get it wrong. You work hard, you put in effort, you are a guy who has a lot of skills, analytical skills. But you don't have to bet the farm on any one single thing. So if you diversify, in a way you're protecting yourself. And the big debate here among people like Buffett, Klarman, the really smart guys are how many stocks can you have? And typically most of them say somewhere between 15 and 25. So you can have conviction. You can articulate that conviction by owning 6%, 7% in a stock. But at the same time, you make sure that you don't blow up. If bad things happen, you're still pretty much protected. But what does the Indian fund manager do? That's really fascinating. So I've recently started investing in equity funds in India because I'm now becoming senile. I don't know what the hell is going on in my life. The average Indian fund manager, he comes publicly and says, these are my 5 best ideas. He comes on CNBC and says, you should buy this. The joker owns 54 stocks. Sir, I have solid conviction, sir. He has 2.5% in the stock. They should just be smacked for doing that kind of thing. The second is the Feynman technique. If you want to overcome your ego, you don't know something, first, try to figure it out. Second, go into great depth about it. But you know the third one, which really rids you of your ego? Explain it to your grandmother. If your grandmother is able to understand your explanation of a really difficult concept, or like Peter Lynch said, draw it with a cartoon on a piece of paper and show it to your dog. They're both equivalent. I mean, not that your grandmother is like a dog, don't get that wrong, but the idea is the same. And that is what Richard Feynman, one of the world's most intelligent physicists who won a Nobel Prize, used to do, because he wanted to conquer ego. He was in search of the truth. Take the outside view, which means, and this is just the reverse, don't go to management and say, sir, next quarter का क्या earnings है sir? जरा outlook बताइए ना, sir, conference call कर रहे हैं आप? मैं पहुंचता हूं sir, आपके conference call पे पूछूंगा. No. It's read the goddamn balance sheet, read the financial statement, the cash flow statement, and try to figure out, given the history of the last 15 years, what is most likely to happen going forward. Select a bunch of companies who are competitors, see what has been the distribution of outcomes of that group for the last 10 years, 15 years, in similar periods, figure out what the odds are. Then, if you must predict, predict on that basis. That's the process you need to follow. Okay, next. Yeah, we've spoken about this. Doubt, invert, descent, same idea. This is one that they told Vidu in IIM. They said, there are no right answers. Just seek the right questions. When I was in IIM like Vidu, I used to think, what a bunch of morons these professors are, yaar. Because sala koi akal hi nahi hai. One, they don't have faith in their own teaching. They're telling me there are no right answers. Ye kya gajab hai? And then second, I said, yaar, what are the right questions? Much later in life, did I realize that these guys are right, I'm the bozo. So this reminds me of a very famous professor of mine. And the question, there were 2 things he taught me, which have stayed with me for life and vastly helped whatever limited investing skills I have. One, he said, and this is really reflective of how you must think about investing. He said, you can take horse to water. You can make horse pass water. Oh, sorry. He said, you can take horse to water, you can make horse drink water. But you cannot make horse pass water. That man was a genius. I mean, he wrote many books on finance. He taught at Allahabad University. He was a wonderful man. And his soul RIP. He also said another wonderful thing in the context of working capital and evaluating crooks. He said, for the benefit, he was very anti guys who couldn't speak Hindi because he came from Allahabad University. So he thought it's a birthright of his that everyone should speak Hindi. So he said, for the benefit of, no, he would say, bhagte chor ki langoti sahi, For the benefit of those who do not understand Hindi, referring to all the guys from IIT Madras, bhagte chor ki langoti sai, yani running thief, underwear better. Okay. Now, how do you manage overconfidence? This is the trick here. You got to be willing to accept your mistakes. That is why I think the best investors are people who have great humility, who are willing to accept that they've gone wrong, who want to recognize their mistakes, who are not in denial. That allows you to learn. And then once you begin to learn, once you start that process, go deep. Once you have recognized that you made a mistake, think about it in multiple layers. Don't be happy to stop the first time you think you figured it out, because the true learning will take place when you explore anything in depth. And think slow. Don't be in a hurry to jump to conclusions. You'll save yourself a lot of money in life by thinking slow. Daniel Kahneman. Not thinking fast. Procrastinate. If there were a mantra to good decision making, it is procrastinate. And you can have conviction. Once you make a rational, evidence-based assessment, take a long time to make that decision. But once you've made it, don't be like the Indian fund manager and buy 2.5%. Yeah? Because you're shortchanging yourself. You're betting against yourself. If you're smart and you know it, show it. Right? They used to say it about money. If you have it and you know it, no. Then flaunt it. Or something like that. There was a saying like that, which I thought was so wonderfully Punjabi and so right. Yeah, this is an important one. Consider crowd wisdom. You know what crowd wisdom does? Collective opinion of large numbers of people is very powerful, because each guy has brought to bear different thought processes to answering the same question. It helps you to deal with saying, I know the answer. You don't know the answer. That's where you start. The three most useful words he spoke about this time is different. Yep, those are the most expensive words in investing. You know the words which are really important after that? Woo! I'm wasting my time here. There are men with PhDs in psychology who know the answers. The answer is, I don't know. The minute you get to that stage, you've dealt with a huge problem. Okay? And the second thing is, this is how your thought process should work if you want to get over your ego. Come up with a thesis, collect data, collect evidence, get someone to argue against you. Then isolate from that process of thesis and antithesis what is best, then act. Synthesis. This is Hegel, famous philosopher. Okay, next. Yep. So, why does conservatism happen? Because of loss aversion. Gains have much less value than losses, and you don't want to change. So, we want to benefit our current selves, who we are today, rather than think about the future. It's called hyperbolic discounting in psychology. So the best example of this is what Coke did in the US. They launched a new version of Coke. They did lots of blind tests, very rigorous market research, XYZ. And the market research showed that new Coke is a winner. Then they launched it. The same people in blind tests who had said it's a winner, when they drank new Coke, they said it's shit. We like old Coke. But Coke did the smart thing. They withdrew the product instantly. That's the lesson to be learned. Next. So how do you conquer conservatism? One is, think in terms of long-term rewards. Try and figure out when you buy your next stock, can this stock compound at 15% over the next 4 years? It may be back-ended, it may be anything. But don't worry about how much you can lose in the short term, because that's going to distort your willingness to evaluate it rationally. And you know, one of the wonderful things about the smartest investors who are behaviorally hardwired to be successful, they buy things that are perceived by others as being more risky than they are. So I'll give you two asset classes. There's one asset class, last 80 years, there's no 20-year period when the asset class has lost money, and the relative average of that asset class is 7% over the 80 years, and the maximum that you would have lost in any single year is 53%, and over 1 year XYZ. The second one, average annual return of 4.5%, in the long term, inflation destroys this asset class. But it's seen as being much risky than the first one. Can you tell me what the two asset classes are? Stocks and bonds. Right? So everyone tells you stocks are more dangerous. They're not. It's bonds which are far more dangerous. Because inflation destroys bonds. Right? So that's how it works.